Have you ever been curious about what the Bank of England does? Informally, the Bank of England is known as the Old Lady of Threadneedle Street. The bank has been located on this street for the past 300 years in the heart of the city of London. The name comes from the year 1797, when James Gillray published a cartoon portraying the bank as an old lady being wooed by the Prime Minister William Pitt. But before we talk about the Bank of England, we should ask ourselves, what exactly is a central bank? A central bank is a financial institution that has been given privileged control over production and distribution of money in a nation. Central banks are legal monopolies and comprise of officials who are not elected. Central banks implement monetary policy, while governments implement fiscal policy. The oldest central bank is the Swedish Riksbank, which dates back to 1668. A few decades later, in 1694, the most famous central bank of the era, the Bank of England, was set up. In contrast to central banks, high street banks are the traditional brick-and-mortar retail banks in the UK. Some reputed high street banks in the UK include Barclays, Royal Bank of Scotland, NatWest, and HSBC. So let's take a closer look at the Bank of England. The bank makes sure that money exchange is safe between individuals, whether it's cash or payment services. It also supervises financial exchange between institutions. The bank plays a supervisory role via the Prudential Regulation Authority. It monitors other financial institutions and banks. The Bank of England assists in keeping prices stable by maintaining inflation at 2% and boosting confidence in the UK's financial system. So how would you define an interest rate? Put simply, an interest rate is the cost you incur to borrow money. In this illustration, Maddie has borrowed £100 from the bank. If the interest rate were 3%, she owes the bank £3 in addition to returning the principal. The bank rate is by far the most important interest rate in the UK. The bank rate is the interest rate the Bank of England pays commercial banks when these banks hold cash with the Bank of England. This in turn affects what rates commercial banks can offer to individuals and institutions. When interest rates increase, loans are more expensive, reducing spending and thereby decreasing inflation. This is called monetary policy with contraction. When interest rates decrease, loans get cheaper, increasing spending, thereby increasing inflation. This is called expansion. So at the end of this, why don't you tell me, what is the current bank rate? Do you think it's high compared to the last decade? A quick hint, you might want to look on the Bank of England's website.